Hello, David and I hope you're having a fantastic day, and thank you very much for opening this video.
Today, Harry and I are going to talk to you a little bit about inflation and some of the risks that people don't often talk about when we're making safe investments. Inflation is a quantitative measure of the rate at which the average price level of a basket of select goods and services in an economy increases over time. Inflation is often expressed as a percentage. When you listen to the news and they say inflation is at 2%, this means that on average the cost of living in our country is increasing by 2% year over year. When planning for retirement, it's important to remember to factor in inflation because over time your cost of living will increase significantly. If you don't plan for inflation, then you are at a greater risk of outliving your savings. Although inflation is relatively low currently compared to historical averages, even at low rates, inflation can eat away at your savings in a meaningful way over time. Central banks have generally targeted an inflation rate of around 2% in recent decades, and this seems to be their target moving forward for now. As this chart shows, you can see how even a relatively low inflation rate erodes purchasing power over time. At 2% inflation, 20 years from now, $10,000 will shrink to only $6,729 of purchasing power.
This is another good chart that illustrates the impact of inflation over time. You can see what the price of a pound of butter was in 1965 at 63 cents compared to a pound of butter costing $4.52 in 2014. The biggest increases have been for essential items. For example, between 1964 and 2014, clothing prices increased 254%, or 2.5 times more expensive. Food prices increased 782%, or almost 8 times more expensive. And gasoline prices increased 1,391%, or almost 14 times more expensive.
Guaranteed income certificates are often considered a safe investment. With a GIC, you will lock your money into a term deposit with a bank for, say, a year. At the end of that year, the bank guarantees to repay you all the money you locked in, plus pay you some interest on top of that. Fixed income investments like GICs are appropriate for any money you intend to spend within the next 3 years. The rate of return is not very good, but the guarantee they offer is attractive for short-term goals. For longer-term goals that are more than 3 years away, GICs are usually not recommended. As of right now, a 1-year GIC is paying about 2.5% interest. Currently, inflation in Canada is at just shy of 2%. After taking taxes on interest income plus inflation into account, investing in a 1-year GIC in today's environment means that in 1 year from now, when you get your money returned to you from the bank, it will be worth less than it currently is in terms of its purchasing power. For this reason, it has often been said that investing in GIC is a safe way of going broke. As the chart below shows, since 2000, the real rate of return after inflation and taxes of a 1-year GIC has been negative in every year but 2. Even in those 2 years where 1-year GICs were positive, they barely squeaked out a positive real rate of return. This chart illustrates that if you have a mid to long time horizon for investment, like more than 3 years, you should strongly consider adding some equities into your portfolio for better growth potential to offset the impact of inflation.
Also, as mentioned, GICs are also good if you have a short time horizon until you need to spend your money. But in general, if you have more than 3 years to invest and you are comfortable with some volatility, then a diversified portfolio of stocks and bonds is going to help prevent inflation from taking a large bite out of your savings and will allow your money to last longer. As always, if you have any questions or need any help, please give David and I a call.
Have a great day, guys. Until next time.